Welcome back, everyone. Looking at responsibilities now. So that expectation gap between what the management do over there on the left-hand side and what the auditors do over there on the right-hand side. Got to be clear because people often think auditors do or are supposed to do more than they actually do. So let's have a look at what the responsibilities are. First of all, it's up to the management, it's up to the board to deal with corporate governance, regulations and codes. Okay, not up to the auditor. The auditor can say, well, you don't comply with the code, but the actual compliance is to do with the board. It's the board's responsibility, and it's the board's responsibility to communicate with shareholders. It's also the management's responsibility to prepare financial statements. Okay, as far as the auditor is concerned, they just give the opinion on the financial statements, on their truth and fairness. When preparing the financial statements, then the management will have to, obviously, not the auditor, will have to select the policies and apply the accounting policies, okay, and also make all the judgments, the estimates that's needed. That's all done by management. They also need to design and, of course, implement controls. Okay, and these controls, by the way, what they're supposed to do is safeguard the shareholders' assets, make sure things don't get stolen, and make sure they're looked after properly and used well. Make sure that the controls give out reliable information. And finally, and we're going to look at this in a bit more detail in a second, prevent and detect fraud. Okay, so design and implement controls. What are those controls supposed to do? Those three things. Now, over for the auditor, well, in terms of the auditor, all the auditor's got to do in terms of control is just assess the control risk. Okay, and this control risk is the risk that the controls won't work, won't give out the information that we need when we're gathering evidence. Okay, so what we've got to do then is to do this, we need to test it, and then we need to report weaknesses. We do not design them, we test them, we report weaknesses, because we want to know, are they reliable to give us information? Because what we have got to do, we being the auditors, is we've got to plan the audit. And that means looking at the risk. We've got to plan the audit to reduce audit risk. Plan it for some risk reduction. Okay, remember, audit risk is the risk that we actually give the wrong opinion. We say it shows a true and fair view when it actually doesn't. So we've got to deal with that. Okay, so they're the basic differences between management and auditors. Couple of things I wanted to mention. You often get, in this area, you often hear the terms those charged with governance. And I just wanted to make it clear what that actually means. Those charged with governance, often they talk about the responsibility of those charged with governance. And it's basically your directors and what I'm talking about there above, your senior management. Okay, it's those who actually supervise the middle managers. Okay, so if you hear the term those charged with governance, talking about the directors, they're talking about the senior managers, those who supervise management. Okay, we will now go on in the next couple of sessions to have a look at specific responsibilities such as fraud and error and talking to those charged with governance and that sort of thing.